April Roundtable. We're very excited to be with you today. My name is Brittany Diaz. I am the Director of Operations and Client Success here at LoanNEX. We have a great presentation and some great co-hosts with us today. Couple of housekeeping items. There is a Q&A section at the bottom of your screen. If you have any questions throughout the webinar, please feel free to throw them in there, and our host will either answer them live or will provide a written answer. And I will now throw it over to our CEO and co-founder of LoanNEX, Eloise Schmitz.
Thanks, Brittany. Thank you all for joining us today. We've got quite a big number of registrants, so looking forward to having a good conversation. And I do encourage that chat, especially in the market that we have now. I don't know what to say other than, wow, it is certainly volatile and uncertain time, even with today rocking all over the place. But you know what we're gonna talk about today is, even with all this uncertainty can come a lot of opportunity, which is really important, especially in today's market. There's so much changing minute by minute, and some of these changes have been building over the past year and really building a lot of demand for the non-agency products. And we're constantly seeing and hearing more people wanting to enter the market so they can serve more borrowers, and that's what we're here to do. So I'm thrilled to have an amazing panel that we're going to bring insights not only in today's market, but what we see coming up throughout 2025. So with that, first, I'm going to open up to Eric Morganson from Angel Oak. Eric is currently the Vice President of Business Development at Angel Oak Mortgage Solutions, and he has built the Angel Oak brand over the last 10 years into one of the largest non-agency lenders in America. He's an expert consultant and producer supporting brokers and correspondent bankers. And I'm very excited to bring your expertise on. So Eric, welcome.
Thank you very much.
I've got Tom Davis from Deep Haven. Tom is the Chief Sales Officer at Deep Haven, and he manages their wholesale and non-delegated and core sales teams. That's a big job. You bring over 20 years experience also, helping brokers and lending partners with their non-agency and non-QM products. And I know we've worked together for a long time, and excited to have you on the platform. So welcome.
Thanks, Eloise. Great to be on today.
And a new face to the LoanNEX side, but not a new face to many of you, is Robert Trahan. Robert joined us just about a month ago, and he is Senior Vice President of Sales and Support with LoanNEX. He brings over 30 years of senior leadership in the mortgage industry and specifically focused on the non-agency market. Really excited to have you on the LoanNEX team and on our panel. So welcome, Robert.
Right back at you. I'm real excited to be part of the LoanNEX team, and I've worked with you, Eloise, for quite a long time, and now trying the other side of the fence on the vendor side. So this is great.
It is. So we were having a quick chat before we jumped onto the webinar, talking about today's market, and we feel excited, scared, fortunate, unfortunate, whatever you want to call it, to be on today. But we're going to try to talk about and dissect what's going on in the market. So I'm going to just go ahead and jump in. We've done our introductions. What we do on this roundtable is really try to keep it pretty open, and we're going to walk through a lot of industry trends and talk a little bit about what is going on currently, what we expect in 2025, and then how our partners from Deep Haven and from Angel Oak are also here to talk about how to best navigate and expand volume in the market. So with that, a quick level set, just we give these statistics pretty much at every one of these roundtables. There's really not been a significant change in the MBA forecast. There may be after this past couple of weeks, but right now there hasn't really been. They're projecting about a 16% growth in 2025 for total originations and 30% for refi, because of a little bit of rate volatility and people being opportunistic in their refinancings. But the refinance side of this is really not driving a lot of the market because so much of the rates are still in the money. So just from a general perspective, do you guys see the market any differently than, say, the MBA does, or sort of where the refi market looks like? Anybody want to? I'll put it up to Eric. I'll start with you.
No change. You guys had the refi market, boy, what a run we had a few years ago, unprecedented run, but we're not going to see these generational rates for another generation. So you just got to put that whole business model up on the shelf and let it age. Right now, we just see just a thriving cash out market. And there's three reasons why we have a perfect storm in cash out over refi is all-time high debt, SBA loan debt, car loan debt, credit card loan debt. We're a debtor nation, coupled with all-time low first mortgage interest rate in place. That's again, a generational rate. Then we've never seen this amount of residential equity in America before. It makes a perfect second TD cash out storm.
So Tom, I'm curious, when you see the volatility going on in the market, do you think that's going to have a material impact on, what Eric was talking about on value, on home values?
Yeah, I don't think home values really, I mean, look, there right now, when you look at inventory, existing inventory, we're at levels that we haven't seen since February 2018. And I think the people who are putting their homes on the market are people that have to sell their homes because of affordability issues. There was a survey done by Redfin maybe a couple weeks back that like 70% of people that are stuck in these low rates, they never plan on moving. And so, I think just with the current rate environment, I agree with Eric. There's plenty of opportunity on cash out for second liens. But from a housing standpoint, we have existing inventory at a high since 2008, and then new construction inventory is at a high that we haven't seen since the great financial crisis. So we have inventory levels that are kind of elevated right now. And what's interesting is that there's a supply demand imbalance in housing, about 4 to 5 million units of single family homes in the United States. And so because of the supply demand, there's more demand than supply because we've had all this population growth over the last 20 years and home builders haven't been able to keep up with the demand. There's this like pent up demand, but the problem is affordability. And I think home builders aren't able to build affordable homes at a profit today.
Yeah, yeah.
High percentage of just new construction. I think it's like 60 to 70,000 between regulatory, legal, permitting, all the like their compliance to build just a home. It's like close to 60 to 70,000. That was reported by the National Association of Home Builders. So, and then you have taxes are, high, and insurance costs are at all-time high, not just because of these catastrophic events, but what's really gone up is the cost to replace, to build a new a home if something does happen to a property because of inflation. So I think, I agree with Eric. We're in this, with the auto credit card. I think auto loans are like 1.6 or 1.1 trillion, credit cards at 1.6 trillion. Delinquencies for autos and credit cards are high. So I think, an opportunity in the market is going to be second liens because people are going to need to consolidate debt and they're going to need to renovate their homes because they're going to stay in their homes for many years. And so that's I think that's an opportunity. But today's been this last couple of weeks have been kind of wild with the rate environment and how rates are really moving due to what we're seeing in with some of the actions of the administration.
Yeah, and that's where I was going to take us next. It is remarkable, just since February, how, and we try to put these, in just different points because they're changing so much all the time. But wow, the rates from Friday, which is the purple line, shows a pretty significant drop from just 6 weeks before. And not necessarily in like the Fed, we haven't had a rate drop, but it's all the longer term rates and all those middle term, the middle section of the yield curve have really dropped. And right now, that 30-year is down to where it was in October, which is incredible. But it is really unclear what's going to happen. Are rates going to have to go up with inflation, with the tariffs, or are they going to come down with a recession? It's very unclear how all of the market's going to move. And what I think is, interesting, we've got the yield curve on one side, and on the other side of the page are really the non-agency. These are LoanNEX index rates for the gold, green, and blue that are on here, and the black are the 30-year agencies. And when we track this, it's been a very interesting change in the market. So this is, over a little bit, about 15 months worth of data. And what it's showing you is the agency rates are moving as we know, with October being that low point. But what we also saw last summer was the convergence of what we call the gold rate, which is, that prime credit box, and the DSCR is the green. And those rates converged really as market demand for that DSCR paper continued to increase. They really converged all in the rates. But what we're also seeing is the spread between agency and the gold was pretty wide 15 months ago, and how much it's narrowed, and now it's really narrow. But it's widening a bit for the wider credit. So these are just some metrics to show what's going on in the market, but there is really, really strong institutional demand for the DSCR paper, and what I would say sort of that right down the middle strong credit box for non-agency paper.
Yeah.
And what we also see is there's constantly, I'm going to say, nips and tucks around the edges as people are trying to find that sweet spot. I would say folks like you guys, Deep Haven Angel, because you're trying to find that sweet spot of where to put the product so that you can get the volume in there, but also price it right. So that's what you're seeing with some of these spreads. But I'd love to hear from either of you about, like, how do you see both the credit box changing? How do you see the rates moving?
Yeah. Look, performance in non-QM, while delinquencies have gone up, across the, all asset classes, mortgage, related asset classes. If you just look at the last 3 years of performance in non-QM, if you look at the vintages over the last 3 years, the overall losses for all products is around 2 basis points and not 200 basis points, because there's so much embedded equity in those deals. I think our average LTV is below 70 in the high 60s. But if someone bought a house 3 years ago or 2 years ago, they've seen appreciation, so potentially their LTVs are in the high 50s or low 60s. So if someone goes delinquent, they're going to catch up, or they're going to sell their home, right? Because they have all this equity. They're not just going to walk away. So the credit performance is great. I think the average LTV is like in high 60s, low 70s. FICOs are in the high 700s or 740, 750. DTIs are in the low 30s. So, great performance on non-QM. But I will say, I've seen recently mortgage spreads kind of widen in the non-agency space, like, in the last week, because there's been an increase in recessionary kind of predictions. And if when that happens, investors are going to want higher yield for higher risk. So you're starting to see some spreads actually widen. And we kind of experienced this. I forgot the time period, but rates were coming down, but the actual pricing the wasn't really getting better, and that's because of the mortgage of that spread kind of widening. So I think the volatility is definitely interesting to see how that kind of plays out. But I think over time things kind of settle, right? And then I think spreads will tighten.
Well, as far as credit grade, what we learned from the financial meltdown, that an 800 FICO borrower versus a 500 FICO borrower really had no bearing when it came to somebody making a business decision and walking away from a house that had no equity. Now, with the ATR regulation, the ability to repay, we're not going to ever see a free flow. So as far as the credit grade, I see that remaining pretty constant. And with all the equity out there, as Tom said, nobody's literally going to go through the foreclosure process. They're literally just, if they can't make their mortgage payments, they're going to sell their house and take that equity off the table. So it's not really the risk out there is all mitigated into the rate. So as far as the bigger picture on what's going on with the market, it's unstable, obviously. Well, when there's an unstable market, what is it? the investors, seek out bonds. And we have to deal with this $35 trillion debt we have as a country. So we're paying such a high interest rate on that debt right now. What do we need to do? We need to lower that interest rate so our burn rate on servicing that debt gets down lower. Well, how do you lower the rates? Well, the instability in the market is seeking bonds, and that's literally going to be lower the rate. Now, is that the Trump administration's master plan? I don't know, but it seems to be working out in that direction.
Yeah.
Hey, I will say, Eloise, one other thing. We've seen this happen in the past, and seen companies go out of business, right? That weren't, just sophisticated or didn't hedge their pipeline, their non-QM pipeline. If investors are out there buying, moving with the market and kind of playing the market and lowering their rates to really drive volume in this volatile market, and then an announcement comes out or something happens and rates actually shoot up, you can see, investors sitting on a lot of lowered coupon rates, and now they're exposed, and they can lose a significant amount of money, and it's put companies out of business. So what I would tell the audience is, when you're working with an investor, works with an investor that has access to either securitized or has insurance-based capital, because you want to work with an investor who's dependable, reliable, has multiple execution exits in today's environment during a volatile period. And I if it was me and I owned a shop, or if I was a mortgage banker or a broker, I would make sure that the investor I'm working with has diversified exits and multiple liquidity, because we're in a volatile market. We've seen this kind of happen in the past.
Well,
That brings up a good point. Work with a lender that will honor your rate locks and not condition until the lock expires, like back in 2022.
Yes, that is very, very, very important, as we know. And this is a sort of a great segue into so much is changing. There is strong liquidity, and I think having multiple exits is really, really important. But you're also seeing new entrants come in, more options. I don't think that negates the diligence you need to do with who you're working with and what their takeouts are. But I do think it's important to understand that this is a different market. There is more liquidity. We're not looking at a 2% market. So the institutional market is going to be interested in staying in. When we went from, a 6%, whatever it was, 5 or 6% market down to a 2% market, that really changed the participants too. So some of the things that are going on are driving, growth in the origination and growth in liquidity. And those are really, really important things. And while, Robert, you've only been on this side of the desk for a little while, you certainly know this market well. And we are seeing such changes in programs and expansion of programs and expansion of takeouts. I'd love to get your insights on some of that as well.
Well, I mean, as companies are looking at managing their product risk in terms of diversification for the originators, because they're really concerned about recruiting cannibalism, right? Where people are basically, if they're not providing the full suite of products, their originators are at risk to leave. So that's one thing that our retail originators are out there looking to do, is to add this product to their bottom line. And more importantly, as the margins on agency and prime jumbo continue to contract, where do you look for? I mean, obviously you can look at Ginnies as being a higher margin product, but you're also bringing in a lot of borrower risk into that, less down payment, lower FICO scores, and that's where the non-agency products clearly create a lot of additional revenue for the company with minimal credit and product risk. So it's amazing. There's a lot of companies still out there that are not even offering this product for their originators.
It's unbelievable.
Unbelievable. I don't understand it.
I don't understand it either. They're at a competitive disadvantage, and their loan officers can't do loans. They're going to go to someone else that's able to do the deal. And I mean, we're actually training our customers, right, on all these products. And so look, the top 5% of realtors or realtor teams in the United States account for 90% of the listings. Well, I'm going to say this
Plus.
again to all the originators on here. The top 5% of realtor or realtor teams account for 90% of the listings. That means that the 10%, that the 95% of realtors out there only have 10% of the listings. The reason half of the originators in the United States are not really doing material production or just are under indexing in a big way is because they're calling on the 10% of realtors or the 95% of realtors that only have 10% of the listings. So what we do is we work with our clients and say, hey, become an expert in non-QM, bank statement, DSCR, second liens, ground up construction, fix and flip, bridge, you name it, a full suite of products, and go call the 5% of realtors who have 90% of the listings, because they're the ones who are moving the weight, right? And you've seen it the last 3 years, we had 150,000 registered NMLS LOs. I think it's now like 85,000. So like we lost half of the LOs in the industry. And I think there's going to be more LOs that are going to actually tap out or originate, or companies are going to tap out because they're calling on realtors that don't have listings, and they don't have a product offering that differentiates themselves, right?
Exactly.
So we're saying pick up the phone, call the realtor who's moving the weight in your backyard, and say, I have expertise in these products. I can help you put more people into homes and help you close more deals. And if they're working with 2 LOs in their market, don't have access to these products, then those originators will now penetrate those relationships and not only get the non-agency, but start get the agency business as well. So I'm a big believer in every market there's opportunity. Either you take share or someone takes yours. And so I think this market, you just got to be aware of what's going on, have access to all products, be an expert in your field. Just like if you're an attorney and a financial advisor, whatever it is, if you're really good and you have expertise and you can differentiate yourself, then people will do business with you and line up to do business with you. But you got to target the people who are moving weight, and not just the realtors. A third of the market today is new construction. A third, 1 out of every 3 purchase transactions is a new construction deal. So how do you get more deals from the guys that are building? You work with the real estate investor. You work with the developer, the builder. They all need financing. Provide financing to them, help them build those properties or renovate the properties. And then after you do that, then you can do the takeout loan for the borrower. Now you got 2 deals from 1.
So I want to, sort of bring that, all those points are really a lot of what we've covered and are covering right on these slides. And what you were just talking about is a lot of that demand. So you've got a changing base of, from refi to purchase. You've got changing borrower demographics. We've got changing liquidity sources, which I think are going to actually change pretty dramatically over the next year to 18 months as well. So you've got, a lot more entrants from institutional side, because of the way the rate environment is, it's attractive to them. The credit metrics are attractive. These are not high risk loans. These are very strong loans that have a good return. These are also things that, for all those things that Tom just brought up, every retail organization should have these products. I was just at the MCT conference, I guess, last week, and it was remarkable to me how important these products have become to their portfolio, where it wasn't a year ago, where it might have been 5 or 10% of their volume. It's now 30 to 50% of their volume. And that's because when you're dealing in this purchase market and there's more options, there's more liquidity, the borrower's profile is changing, the agency box is changing. There's so many pieces that are changing that it is making it really important for people to have these tools in their toolbox. And we're going to talk about how, like all those things you're just talking about too, Tom, about where to market and how to best do it. But the market's changing. And so Eric, love to hear from you too on how do you see sort of this evolution changing of, what products are, going, we saw it in two slides. I'm going to flip back and forth. That non-QM origination, that's just securitization, but non-agency in general, because of the portfolio shift from portfolio banks into now insurance portfolios, those are different takeouts, but it is, again, increase in liquidity and a change in product access.
Well, what drives, Tom's business in mind, Deep Haven and Angel Oak have been around for a long time. We've been doing bank statement loans for over 11 years. We've been in this space. And boy, 9 years ago, doing a bank statement loan was wonky. You had to have a CPA signing off on P&Ls, and it was, well, it was kind of wonky. And it was, every borrower, the rate was 9.99. That's how we entered this marketplace. And boy, have we gone through 16 different renditions on how do we calculate the income on a bank statement loan. So it is constantly evolving better. Now we have AI looking at the bank statements and giving you an immediate decision that you just simply QC over. So it has gotten streamlined. But for all those originators out there, we do a lot of webinars, and we always survey the loan officers who has done a bank statement loan out there, and it's only about half. Now, what is the barrier to start doing bank statement loans? Well, we all fear what? The unknown. And you're going to talk to a self-employed individual who's, a very domineering personality. They're alpha. They usually are getting what they want, and they're going to steamroll you if you're not really comfortable about originating a bank statement loan for these wealthy self-employed individuals. At Angel Oak, we're going to just walk you through this process, show you how you originate this. Why would you want to go business bank statement versus personal bank statement? We literally educate our brokers daily on getting good at this alt income business model, because you're right. They're saying that, 8 to 10% of your pipeline is going to be non-QM. We call BS on that. It's going to be 50% plus. Why? We look at the mortgage market out there. Look at all these missteps. Here's a loan that makes perfect sense. Fannie and Freddie push back on it like non-mortgable condos. Who cares if the condominium complex is 100% rentals? They tap out at 35%. So we look at all of the reasons why agency pushes back, and we jump into these buckets. And there are hundreds of thousands of borrowers out there that do not know that these programs exist. So that's why we have marketing for our brokers to help you get the word out that these loan programs even exist. We need your help.
Yeah.
Well, it's true, and not just help knowing the programs, but it may be that you think you know the answer to the program, but that may not be the best answer for your borrower. And that's where really, you don't have to be an expert. I'll put a little plug in for LoanNEX. You don't have to be an expert, but you should be able to navigate tools and lean on your partnerships to be able to find those right answers. This is data that, some of the left hand of the slide Tom gave me, which I think is incredibly interesting. And the right side of the slide is data from LoanNEX, which brings some of this into 2025. But when you look at these trends, this is what Eric was just talking about. When you look at some of these trends, there was a strong growth in the DSCR product and that bank statement product. And that's what's driving a lot of the non-QM. This is just what's gone into securitization. So this does not include loans that may be on balance sheet or portfolio loans. But what you're seeing is what's going into securitization isn't, just, trying to figure out how to fit the DTI and the interest only and what's, sort of like the first level of non-QM is. You're seeing it develop to fit the borrower's needs with more bank statement loans and more DSCR properties. And you see some of the alt doc down below. We're seeing some of the foreign national grow. We're seeing some of that CPA and P&L. Those are CPA and P&L along with bank statements. Those are self-employed borrowers. They are self-employed borrowers that people now realize this is not a mountain that I can't get over. This is actually a very doable loan. But there's a lot of data in here showing us how this market is evolving. This is not a bad, poor credit market. This is about serving borrowers with products that meet their borrowers' needs.
Yeah. Eloise, I would say, look, just like there's agency borrowers, there's non-agency borrowers in every town, right? There's high income, high net worth, there's self-employed,
Yep.
there's investors, there's foreign nationals. In the United States, there's over 19 million people who are self-employed that own 30 plus million businesses. There's close to 20 million investment properties that account for 49.5 million units or doors. Last year, 1 out of every 4 transactions was a investor transaction. So if a quarter of your business is not investor transaction, you're under indexing the market,
Right.
right? So you have to have DSCR, you have to have 5 to 9, you have to have fix and flip, bridge construction, but a DSCR second, right? To work with investors and go to the investors to have a full suite of solutions for investor transactions, right? So that's an opportunity. Self-employed, we talked about that. Those are all, bank statement deals. And then there's over 40 million people in the United States that weren't born here. That's your foreign national I-10, right? Kind of borrowers. And so there's so much opportunity out there and so many borrowers that need solutions, non-QM solutions that, and including, the second liens, right? That's a huge, opportunity because we could do a HELOC, we could do full doc, we could do P&L bank statement, we could do DSCR seconds. So having a full suite of second lien solutions, and whether it's consolidation or renovation, and as rates come down, I think the biggest mistake that originators today are not focusing on is on second liens, because and look, the reason it's a problem is because that borrower, if you don't serve them and you don't stay in touch with them and ask them what their financial, goals are and what's going on in their life, someone else is going to give them a second lien deal, and then they're going to get that relationship. And then when rates do come down and it makes economic sense to cash out or on the first and include the second, then they might not go to that originator who gave them, that first. They're going to go potentially to the person who gave them the second lien. And so,
And it's a great structuring tool. I mean, not only is it a great tool to win with that borrower and have, be top of mind with that borrower, but it's also a great structuring tool when, with some of the foreign nationals that you were talking about a second ago. And the FHA, guidelines have changed, and a lot of that is out. Those products are available in within your portfolios, within the non-QM side.
Mm-hmm.
They may not have as high a loan to value.
Yeah.
And that sucks. Yes, it's great to be able to go to 97% loan to value. There's products out there that are very strong products serving the foreign national market, but they may need to be paired with a second. I'm sort of curious. This is brand new, but how are you guys helping advise people, with, say that part of the market that is going to need to shift?
Well, what
Yeah,
we do is, listen, they're going to keep doing their purchase loans. They're going to keep doing first mortgages. We're not saying stop what you're currently doing. We're just saying add to that this suite of cash out. Again, a cash out loan is more urgent than a purchase loan, because once this self-employed borrower, and never underestimate the desire for an entrepreneur, somebody self-employed, to get their hands on capital. And for years, they're staring at all this dead equity in their property. They can't get to it unless they refinance their first, and nobody wants to touch that rate, or they have to sell their house, and then where they're going to go. There's just tons of dead equity. And if they're a bank statement borrower, self-employed, they can't walk into Wells Fargo or a credit union and get one of these loans.
Right.
And of course, we all know if they pull money out of their property and redo their kitchen, it's not tax deductible other than the mortgage tax deduction up to $750,000. But if they pull $500,000 out of their property and they pay off business debt, or they apply it towards their business, it's 100% tax deductible.
Yep.
These rates are lower than SBA loan rates at half the paperwork they would have to fill out. Now,
that's actually a really, really good point. Yeah.
There are millions of self-employed Americans, and according to Forbes, there's 57 million Americans that identify as self-employed. What does that mean? They might have a job at Apple, and they don't want to leave that job because of their benefits and stock options, but they have a side hustle of programming over here on the side. that side hustle community. We take both a W-2 and their side hustle income to get them a bank statement loan. You guys, there's so many borrowers out there that really could use these cash out second mortgages that don't know that they exist. And who's sitting on a database of self-employed wealthy Americans who write off everything on their taxes? Who's sitting on said database?
You know what's interesting, Eric, just to piggyback off your like commentary. I know we're
Tom,
talking
real quick, let me just finish.
Yeah, go ahead.
CPAs. CPAs make the most wonderful referral partner for their wealthy self-employed clients. They're doing their job, literally navigating the 75,000 page tax code we have in this country and getting their self-employed borrower all their deductions. But now when it's time to go get a loan, they don't show enough income. What an amazing referral source. Go ahead, Tom.
I would say the biggest news outside of tariffs last week was, or in the last 10 days, is Rocket saying that they're going to be purchasing Mr. Cooper. Rocket's like one of the top originators in the country for second liens, right? They issue their own securitizations. When they buy the MSR for Mr. Cooper, they're going to have $2 trillion, 1 out of every 6 loans. And Mr. Cooper also does a lot of the second liens, right? So all those loans that brokers or bankers sold to Mr. Cooper, that's going to go to Rocket. And you know what they're going to do? They're going to be soliciting those borrowers for second liens. So I promise you, they're going to be contacting 1 out of every 6 loans. And so they're very efficient. So if it was me and I'm an originator, I'd contact every single client that I ever did business with over the last 10 years and say, hey, you got a ton of equity. I can help you with consolidating your debt. I can help you with doing some renovations. That's one approach that I would, and then all the loans that you've ever done, investor transactions, right? Reach out to all the last investors and say, hey, I have these suite of products you can cash out with the DSCR second to go buy more investment properties. You need to tap into the low rate, because that's going to worsen the cash flow, right?
Tom, I'm gonna break in here real quick and switch it up just a little bit, because we have a couple of questions from the audience. And I don't know who wants to take this, but one of the questions is, what loan to value do you do for I-10 borrower home purchase and rate term refis? Because we were talking about that a bit ago, so they're curious about what kind of loan to values should they expect from this part of the market.
For an I-10 borrower, we're at 75% cash out, 70.
Tom?
Elise, I would say we're in the same ballpark. I don't have the matrix, but that sounds about right.
That's perfect, but that gives everybody an idea. So it's not 97, it's in that 75 range, but that still is telling you there are options out there. And, like we were just talking about, it may require a little bit of creativity of adding a second lien to it to get where they need to go. But there's a lot of options. When the agency changed pricing for second homes, I'm switching it up a little bit because it's some of that same kind of information. People were very frustrated because now these loans are really expensive, but the non-agency side of the market was serving this part of the market with very efficient rates. And so again, this is going to be another one of those changes. And as you go and tap into more options and more resources, you're going to find that there are a lot of options out there. They just might not be where you're used to looking in the agency side of the house. All those self-employed employed borrowers, like you guys were talking about, makes it a lot simpler to navigate with all the tools that your partners have and the options that are available.
Eloise, real quick, here's some low-hanging fruit out there that a lot of people don't know. At Angel Oak, we go off the primary wage earner's credit score on a bank statement loan. 2 years ago, rates were pretty high when the 2-year swap was, having a heart attack, let's call it. And right now on a DSCR loan, we go off the higher FICO score out of any borrower that's on there. So you can see as much as a 2-point a rate reduction in rate. So there's ample tangible net benefit to go to your book of business on bank statement loans you've done in the past, which you use the lower of the 2 borrower co-borrowers FICO score. Now you can use the primary wage earner's FICO score. there's a refi opportunity in legacy non-agency loans out there.
I appreciate that, and I also I see, Tom, that you're covering off on some of these more specific questions on some of these programs, which I think is great. Let's see.
Hey, Eloise, like to jump in for a moment here. There's
Perfect.
two things to think about going into a lot of the changes that are occurring in Washington. Non-permanent resident aliens may be suddenly tomorrow may be a new opportunity for everyone to start servicing, right?
Yeah.
You know, I-10 has clearly been something the agencies would not touch, but they would support the non-permanent resident aliens. We may be seeing a shift in policy, obviously, around that, and from the non-agency space, we need to be ready to serve those borrowers. So that's one point. In addition, for all the kind of the executives that are on the call, when you're looking at the price elasticity of agency versus non-agency, and more specifically the investor, the DSCR products, those borrowers typically are price inelastic. So as you see here, that segment in both of these charts continue to grow, because regardless of interest rate, as long as they're cash flowing, the investors are going to be wanting those type of products. So when 2022, when the rates went the opposite way and everyone started downsizing and pulling back their operational staff, if you're focusing you definitely have those DSCR investment type of products out there, fix and flip, et cetera, you can help mitigate that contraction, because we're seeing definitely inelasticity in the pricing world on those type of products. So
hey Robert, speaking on the investor, so we have access at DPAVE, and we have access to ground up fix and flip and bridge. So we could do ground up for a single entity up to $20 million, where you can work with the builder and finance the builder to build a $20 million property. We could also go up to 9 units. So if you think about, like, how do you become a part of the solution as an LO for the next 20 years or 10 years, because the biggest home builder in the United States is D.R. Horton, right? They make 80,000 homes a year. If they increase output by 10%, that's only 8,000. We got to build an extra like 800,000 to 1 million homes a year to kind of meet this population, this supply demand imbalance. So how as a loan officer, how do you become a part of the solution? Help builders with financing so they could actually build homes. And it's not the big builders don't need this kind of financing. It's the regional builders, the guy that does 5, 10, 100, 200 units, right? And then you have to bring uninhabitable properties back into the market, right? And that's to renovation or a fix and flip. So working with real estate investors, you do the fix and flip. So we've actually made some enhancements to those products in our seasoning requirements. We could go off the appraised value less than 6 months now, and use the appraised value as long as there actually been sizable renovations or rehab to the property. Where before that was an issue, because most folks wanted 6 months for the appraised value. So if you do a fix and flip, we could actually be the takeout and do the appraised value. So that's a huge solution for all the folks out there that are working with investors. Once again, 1 out of every 4 deals is an investor. If you bring that, if you go back to your entire pipeline of investors over the last 10 years and you say, hey, I have access to ground up construction to 20 million, fix and flip, bridge, and I could go off 6 months of seasoning on the appraised value on your fix and flip. Now, not only are you going to get the fix and flip loan, but then you're going to get the takeout loan. So you're going to get 2 deals in one. Right?
During that sales head time, we'd call that a double bubble.
Yeah, and then they real estate investors, they're part of the same real estate investor groups, and everyone knows, so they find out, and they're going to want to add those products in. So, having that expertise with that wide product offering really allows you to tap into that ecosystem or that segment of the market.
So I'm going to jump in again, and when I looked at the registrants from this conference, there's a lot of people, a lot of originators on this call, and they are, either they've been in this space, but not very significantly, and they're trying to get bigger in this space and trying to understand it. I think some of the things that you guys have been talking about is all the investment properties. Certainly LoanNEX hosts all these programs, and we provide the solutions.
Definitely.
We had a slide up here a second ago. 55% of the volume that's going through LoanNEX is investment property scenarios, and that's over indexed versus what I'm going to guess both Deep Haven and Angela do. And the reason why is because people go into LoanNEX so that they can figure out how to do those loans. And that's what we're doing, is we're making it easier for you all to navigate these programs and to find the right Deep Haven program, to find the right Angel Oak program. And what's so important about that is this part of the market is growing. I mean, we priced $15 billion worth of these loans last month. That's a lot. It's a lot of activity, and the loan size is increasing. There's a little bit of change in income doc type only because that's some of the refi activity that's been going on. You can see that on the other side of the page. With some of that, the cash out is always central tool to investment properties as people are pulling the equity out of their investment property to fund the next one. And so once you get in with some of these borrowers, it is repeat business. It's really, really strong repeat business. And I'm saying this to make sure people know that as you're serving this part of the market, this is a really a great way to make sure your programs, your options, and your tools are there to serve, this part of the market. So I want to turn this over to you guys to talk about tips. We're almost finished with our time, and I think it's really important. Tom, you talked about some of these at the top of the call. So Eric, what I'm going to hit you first with, how do you see, we're going to distribute this stuff to everybody, but these are some important tips for how to really either get started, grow your business, or be successful in this part of the market.
Well, instead of non-QM, I like to call it non-agency,
I do
because a
too.
DSCR loan doesn't fall under the qualified or non-qualified banner. So, IO does. So it's really non-agency, and
Right.
it's not tough, you guys. Lean on your account executive. Let them be your Sherpa to lead you all the way to a big broker check hitting your personal checking account, because it's really not that complicated. But you do need to literally start by being curious about these programs and what they can and can't do. And we're here to educate you through the entire process, and even give you marketing to get a pipeline going, and to show you where the low-hanging fruit is, where you can actually start making commissionable income within the next 60 to 90 days with all the missteps out there that your competitors not seeing.
Tom?
So if I was an LO today and I wanted to increase my income, first and foremost, I would concentrate on the realtors that are moving weight. Once again, 5% of the realtor teams have 90% of the listings. I would not waste my time calling the bottom 95% of realtors. I only have 10 of the listings, right? Because you're wasting your time because they don't have listings. So focus on realtors and introduce these products and solutions to them. I would focus on investors. I would focus on self-employed. We keep talking about this. There's more self-employed people and more investors than there's veterans. If you're an LO today, or you're a company and you don't have non-QM on your drop-down as a product offering, or that you don't have investor solutions or self-employed solutions, or you don't have construction offering to work with the builders, developers, and real estate investors, like, you need to add those to your website and start marketing those. We have marketing ourselves, white label marketing. We have over 15 decks that go into deep dives on the products, go deep dives into features, how to source these loans. We spend a lot of time with our clients and our partners understanding what strategy or what target markets that they're going to trying to tap into, and we could help you with that. We also do white label presentations for our partners. So if you don't feel comfortable presenting to realtors or real estate investors, we could jump on your behalf and present on your behalf as your trainer, and they never even know it's Deep Haven. So we do a lot of hand-holding and strategic kind of initiatives to help you grow your business. And then outside of that, we have a bank statement calculator, a scenario desk that sees 3,000 to 4,000 scenarios a month. We can help you structure deals, look at credit, and we're an exception-based lender. So close to a little north of 30% of our deals that we see, if they don't if they don't fit the box, we can make an exception based on compensating factors. So I would say reach out to your account executive at Deep Haven. If you're not working with us, reach out to us, and we'd love to spend some time with you and understand your business and how you want to grow that business. And LoanNEX too.
And thank you. I'm like,
leverage that tool. There's a lot of great. It's a tool if you're in the non-agency, non-QM space. Make sure that you have the tools and resources, and LoanNEX is a fantastic tool.
well, these are great partners of ours. And what I like to say about LoanNEX is it's like paint by numbers. You don't have to be an expert. Yes, you need to have strong partners. Yes, you need to lean on your partners. But if you don't know where to go or what you're going to do, open up LoanNEX, and we're going to show you what you need to do, where you need to go. It's a very responsive input form that also has guideline Q&A for each of these programs. So the nuances of, is it going to support rental income, or is it short-term rental? What are we going to do with the gift funds? How do we navigate acreage limits? There's so many pieces that are nuanced in these programs, and they're really important nuances, but you don't have to be intimidated by it. I put on here technology as your friend, because that's what LoanNEX is. We're going to make those pieces really simple. We're going to tell you what you have to ask your borrower, know what you have to know about those programs to be confident in working with them. And we're always going to give you if you start in LoanNEX, we're going to give you that warm handoff directly to Deep Haven or directly to Angel Oak or to our other 60 partners that are on the platform. LoanNEX was designed to make working with these programs really easy, and very excited to have you guys as partners. And I know, Robert, you used to be one of our customers for a very long time. So
one of the reasons I'm actually here is because you have such a strong, or we now, I can say we have such a strong position in the marketplace, especially around the non-agency space, right? I like to share that it's kind of like a three-legged stool. It's your partners, right? Your outlets, their resources to ensure that you have a strong takeout, the technology stack, and more importantly, LoanNEX, and really helping the originator self-serve, because everyone likes to operate slightly different. Some like to self-serve themselves, and that's where LoanNEX really helps bridge that gap when it comes to knowledge, where they may not know much about the non-agency space, but have a borrower that they know it has to be served. They have to be served by these type of products. And third, the other stool is just continually raising the knowledge base of your originators. You have your resources, but if you continue to drive the messaging and more importantly, the learning within your organization, which I know both Eric and Tom's organizations will do webinars, will do lunch and learns, will do all those type of things to continue to raise the level of knowledge within your organization. You can't lose when you have those three pillars. All right. If you don't have LoanNEX, guess what? You're going to fall over. So when you have LoanNEX, we're there to really keep you level set and more importantly, help grow you for tomorrow.
Well, thank you. And I know that we're wrapping up, and I want to make sure everybody is going to get this deck. There's some information. I think you guys have captured a lot of it really well. I'm going to give you some screen time here, but we've got two amazing partners, Deep Haven, with all the programs that Tom talked about. There's a lot of information on the slide that gives you insights into their programs. Angel Oak is also another one of our fabulous partners and should be one of yours as well. When this deck goes out, what's important is on this last slide, everything's clickable. So you're going to be able to reach out to your Angel Oak representative and reach out to your Deep Haven representative straight from this platform. And of course, you can reach out to LoanNEX as well. very excited about what's in front of us. Even though it's a really tumultuous market, this is a really exciting time to make sure that you have the tools and you're ready to serve the market, because it's going to keep changing and there's not anything that we're going to be able to do about that. But being able to serve it and be ready, have good partnerships, have good technology, increase the knowledge, that's what, being successful is all about. So I want to thank you both for joining us. And I really do appreciate the insights that we had, and we had a very strong audience out here, a lot of people listening in. So this is a really important topic for people.
Thanks, Eloise. Appreciate you having us on.
Well, thank you.